Hey traders, welcome to Charts and Coffee. Happy Friday. Happy non-farm payroll Friday. We're gonna hit the ground running and talk about, frankly, the only reason we are paying attention to things like non-farm, average hourly wages, and then the unemployment rate. What does it mean the Federal Reserve has the green light to do? That's where the rubber meets the road, gang. That's what we're looking at here. So in the wake of that NFP, we see that generally equities are up, and with as strong as a number it was something that we talked about in the Sector Secrets Mastery Room, which is the last couple of weeks of initial claims have led to expectations that non-farm would be better than expected. A lot of those whisper numbers that we talk about were higher than the 193, but not by much. They were higher, but not anywhere in the vicinity of 339,000, which is what we got. That in and of itself would have led us, and therefore the Federal Reserve, given them the green light, to hike. Not just once, but maybe twice. Once in July, maybe once definitely, they'd stick with the June hike, and then possibly again in July. And this unemployment rate said, hold on, that 2 ticks higher unemployment rate, you'll notice, definitely pushed expectations, and I'm measuring this. I'm not guessing, right? Everyone here who's listening, at least if you have been for a while, you know that everything that we get information about that gives us insight to jobs, inflation, and I don't really, at this point, growth doesn't matter because the Federal Reserve has ignored what a recession definition is. So now growth is not that big a deal. And not the other two are far more important. And in fairness, the other two are the two mandates that the FOMC has. Every major G7 central bank has a mandate of inflation, including, obviously, the Federal Reserve. But the second mandate that the U.S. has with the central bank is jobs. And therefore, non-farm payroll, jolts, unemployment claims, the rate, these are all going to change. What we then would expect Jerome Powell and company to do, take a look at June, gang. Yeah, we saw our debt ceiling rally, and anyone who's a reader of This Week in the Market knew, because we talked about the historical rally. Everything's data driven, right? If we go back to 2021 and talk about October and December debt ceiling increases, the movement higher was 1.1 to 2.7 increase in the S&P. So that's it. That's usually about it. Everything else would then have to be other less hawkish, even dovish expectations to keep equities moving higher. But nonetheless, we got our rally out of the way, probably most of it anyway. But now this more disappointing, not non-farm headline number, but rather than unemployment rate. Look at June, gang. So I'm giving you the why, but the bottom line is all you need is this. The why doesn't matter, really. The output's what matters. And the output now is a hold in June. Remember, we were almost at 70% expectation for a quarter point hike. It's now not completely baked in. We're not at 80% yet, but it's definitely taken the lead. July is where we've kicked the can down the road. And now if we are going to get a hike, data dependent, of course, it's been pushed to July. Will the markets like that? Probably, right? Probably. And then that begs the question that we can now ask, which is, when do the cuts come? And we don't really have a clear picture on that. It's still very much later this year. It's still very much more of a November conversation. That is what we have here. And that's it. That's it. This is what we're going to go on. Now, inevitably, people are going to talk about, well, that's not what the Federal Reserve is going to do. I don't know what they're going to do. And newsflash, nobody does either. But all we can do is react to, except for Jerome Powell. And until he's writing a newsletter and until he's giving us his S&P target, the rest of it has got to be data-driven, gang, right? Not speculation. We don't get paid to speculate on what someone's going to do. Front running is actually a low probability sport. We want to ask ourselves, what do we know now and how are we trading based on it? And that seems to work pretty well. So don't put the pressure on having to see the future. Don't put that on yourself when it comes to trading. Okay, let's jump on over to our charts and let's jump on over to our questions. And feel free to type them in. We've got the training room in the house, as well as Facebook and the YouTubes, as well as my friends on Twitter. All right, let's get to it. First up, Marcus asks, I'm checking back in on this on Cisco. Sure. What are my thoughts? Thanks for my insights. Neutral market. It is above the 200. Is it viable? Yes. We have two things working pretty nicely for Cisco. And if I squeeze in the volume profile view for the year, I am curious where size is weighting. By the way, I get a lot of questions about, Rog, what are institutions looking at? They are not looking at secret squiggles. They're not looking at RSIs and MACDs. No. Value at risk and volume based on price. Anything else is just speculation. That's what they use. And that's what, therefore, we will use to decode where we are likely to see size come in. Around 49, Marcus, around 49, which actually syncs up really well with the daily price movement range. There's a volume ledge sitting just below 49, 48, 90, 95. That would be what I would focus on to the long side. Why the long side? We've made it north of the 200. We're in the bullish hemisphere. We need a pullback. And if you are looking to play the pullback, I would wait until we either match the high from Tuesday, May 30, or, because they're very nicely overlapping, around $50.50. All right, so that's what I'd be looking for in Cisco, with more of a bias to the upside. All right, good morning, good morning. Grace asks, how does the VWAP Max, our volume max tool, work with daily price movement ranges and the hourly price movement ranges? Sure. How does that work together? Those work together pretty elegantly, and this is how it does work together. If I know where size is at, and that's what all those volume tools decode, whether that be an anchored VWAP, whether that be the volume profile, the V profile, or whether that be the V score, they're all looking to identify volume at certain price levels, right? Which is actually very different than what most traders do with volume, which is they're looking at volume based on the time of day or the date. I don't do that at all. You'll notice there's no traditional volume histogram ever on my charts. It's all about what price has the most volume, hence that reliance on VWAPs and things like that. Okay, if I know where size is at, and then I know what the reaches of 68% probability of volatility is at, and they overlap, volume plus volatility, now I've decoded the market in a really effective and seldom done way. Most traders will focus on price-based indicators, moving averages, etc., which are fine, but it's one layer of what moves a market. And price alone does not tell the entire story. Price plus volume and even volatility does. So I would use them in tandem, Grace. It's not an either or. You really want to use them together. It's very much peas and carrots in that regard. So that's how I use the two together. Now, if I'm using my V score, let me show you here. All right. So if I'm using my volume max tools, and this is the layout that I use with all my volume max tools, what I can then do is combine that with the DPMR or the HPMR. So if I'm in the zone of a DPMR, if I'm in the zone of an HPMR, what am I seeing with any nearby VWAPs? What am I seeing with the reading on my V score? So they're used very much in tandem. We're supplementing. They're supplementing each other, not supplanting. So great question. Thank you, Grace. Next up is, how is the USO looking? All right, so USO is interesting. I won't start with USO, that symbol, if I am viewing what crude oil is going to do. I'll look at crude oil futures, and then that could map to crude oil stocks. That could map to the micro crude MCL, or then, of course, to your question, Patrick, I could map to USO. I want to be a buyer. I don't have a buy zone yet. So how's it looking? Pretty boring. If I'm going to do anything with crude, it's going to be a day trade until I hit a level either on the hourly or on the daily that gives me a zone that I could take advantage of. And I really am only looking at four time frames in total: 5 hour, daily, weekly. Weekly for my longer term position portfolio, daily for my overnight swing trades, 1 hour for the shorter end of the time horizon for my overnight swings, my short-term swings, and then 5 minute for day trading. So each time frame has a job. I do not use multiple time frame confirmation. I find that incredibly frustrating because if you're following anyone using that, and I used to do it probably about a decade ago, well, if you're using anyone, 1 minute it's the 30, the next minute it's the 5, the next minute it's the hourly, the next, which one is it, right? And I found that frustrating not only to do as a trader, but I found it equally frustrating to have to teach. How do you know what the magical time frame is? The bottom line is we don't. So why not have a fixed time frame for each type of trading? And that's what I do there. So for this, Patrick, 5 minute. I would be really nimble until I get the zones that I'm looking for on the 60 or the daily. All right, keeping with our energy conversation, natty gas. Sure. So JR, if I'm looking at natty gas, again, I'm going to go to NG futures. And then from there, it could map to, frankly, FCG stock, natural gas stocks. That would be sort of the XLE to crude. It's FCG for natty. And then that could ultimately map to your question on UNG. It has been down for a bit, right? So what I want to do here is ask myself, what's the underlying structure? This is a weekly time frame. That is not what I want to do here. I don't know how that turned into the weekly. Okay, that is not what I want to do there. There's my daily and my 5. I don't know how that turned to weekly, but let's go to the daily time frame for natty. And one of the things that I talked about, JR, in This Week in the Market, so for those of you that are This Week in the Market readers, what we talked about on Tuesday with that fresh issue was that we are still oversupplied in natty. And the chart looks exactly like a chart that A, had no seasonal rally, and B, there's too much supply. Now, too much supply, not enough demand. They're not the same thing. The demand is still pretty healthy in natty, but we're just making so darn much of it. The chasm between the two is about 6 billion cubic feet right now. And so there's no reason for natty to go up, right? Demand is there, but the lack of supply is probably what's going to be the catalyst to the upside. However, natty is sitting at an interesting level. And as long as you have a short-term expectation for where it could go, it's sitting in the lower third of the range that we've seen since March. It's sitting at the point of control for 2023. So if there is an opportunity to be a buyer, this might be it. Very short-term move, though, maybe from about 2.2 to 2.5 on natty. And then that's going to be what would make UNG move higher. So the only reason I would ever look at UNG is to likely figure out what an at-the-money strike on a UNG call would be, and that would be 6. And we'll look at the 6 strike on that. All right, moving on. Thanks for the question on crude and natty. And Mr. Walker asks, which PMR to use on an hourly? The daily price movement range, the DPMR. Yes, the DPMR. All right, Alex asks, is this one of the high impact events where Raghee keeps her slippers on, kicks back, or takes a day off? You mean the non-farm? We just finished doing a session looking for the buy in the S&P and the NAS in non-farm. So no, I like to have bonus sessions on some of these hot, really hot, volcanically hot zones, because if nothing else, it takes a sequence that we would put to use every day anyways. And a lot of we've been really doing well with futures day trading, right? And with equities day trading. Day trading is working right now. Doesn't mean that's what we're going to keep doing, but right now it's working really, really well. Last Friday, I talked about the week, and this Friday, I'm going to talk about the week again. So if you're looking at, okay, Rog, how are the sequences with hourly price movement ranges and the V-score in that 1 hour and 5 minutes that you focus on each week? How are you doing? So I'll be posting another video like that today, just like last Friday, and we'll talk about what's working right now, and maybe are there opportunities to start looking at the 1 hour and daily quite yet? Very few opportunities like that. Although my mastery folks, you know that we're going to be managing Apple. We've got to exit Apple today. We've had that swing going on since the 23rd, and we got to exit Apple. we're right into expiration. So we have those June 2 calls. We're hitting T2 today. This is what? Hey, bot, what are we at? 3x on Apple now? Super excited. It's a very short-term swing. And that's exactly what we're going to try to keep taking advantage of. Moves like this, where there are trends in place and we keep a shorter term time horizon. We stay nimble, but we can still take overnight positions. So I'll talk about both of those today. But yeah, non-farm, I have no problem trading non-farm. Oh, or 4x on the open. Oh, yeah, that's nice. Okay. All right. AVGO. And so by the way, gang, it doesn't have to be just day trading and it doesn't have to be just swing. If you segment out your trading day, as I teach traders to do, and focus on, say, for the first hour and 5 minutes in the morning, 9:30 to 10:35, day trading, it frees you up to stop day trading. Because frankly, entries after 10:35 have had a lower win rate for me than sticking with entries between 9:30 and 10:35. And then once I'm freed up away from the 5-minute time frames, I can look for swings like Apple, right? And so AVGO, we're on the heels of earnings, yes. So I would say with this one, this is after the bell today. Oh, yesterday. I don't have anything here to do with AVGO yet. Green eggs and ham. Yeah. I don't have anything I can do with AVGO at the current levels. I don't have a setup that's popping on the daily anyways, on the daily. Could be different intraday, right? Could be very different intraday. So if I don't have a setup on a daily, if I don't see anything that I like on an hourly, we could day trade it. And that's the cool thing about that. All right, next up is good morning, Ben. Put call ratio at 82. I don't use the put call ratio, Ben. No. If we and I'll tell you why. And I'm not saying that if you do use it, it's bad. I'm just saying I don't use it. And here's why I don't use it, though. The markets are a high concentration weighted world, whether you're looking at the Dow, the NASDAQ, or the S&P. Most market internals are not high concentration weighted. They treat every stock in the S&P, all 500 of them, as if they're equally important. They're not even close. Same thing with the NASDAQ. So if I'm looking at all the ticks or the trend or put call, they're not measuring the markets as they are actually weighted. Another reason why I don't give a rip what equal weighted, who cares what an equal weighted S&P or equal weighted composite is doing? That's not the real world, right? And so while it makes for interesting discussion, it's not looking at the S&P for what it is. High concentration weighted movement in the XLK, XLF, XLV, and then the weighted stocks within them. One of the reasons that NASDAQ is able to trade as strongly as it has, yeah, you could say, well, Rog, it's tech. That's true. But tech is the number one weighted sector in the S&P. And tech is the number 2 weighted sector in the Dow after financials. Financials, there's your problem. Healthcare, there's your problem. So if we look at the NAS leading, it's not necessarily what it has, it's what it doesn't have. What it doesn't have is the weight is kind of holding it back is financials and healthcare. That's what's holding the S&P back. That's what's holding the Dow back, right? So because the NAS is blissfully unweighted really in those 2 sectors, and tech is the obviously strong sector here, XLK, XLC, XLY, up and away, right? So if we understand the true composition, we don't go down the rabbit hole of equal weighted indices, who gives a rip about what a made up index is doing? We trade this world. So I hope that makes sense. Yeah. And so put call ratio, same problem, right? Now, let me answer your question without the put call ratio. Now you kind of know where I'm coming from. Is it time for some puts? No, I don't believe so. Not when the market's making a higher high. Take a look at the S&P right now, Ben. And again, at some point, we're probably going to fatigue. But why would I try to guess at where that point is? When in reality, the path of least resistance is what? Waiting for a lower low. So I'd rather focus on weakness. Let someone else pick a top, which is a low probability type approach, and play the movement lower, which is basically the retracement of the reversion. Why don't we say we're above the 200? It's more bullish than bearish. And let's buy calls at support rather than priority. And that's just my take, Ben. So I don't have an answer to your question, but I at least want to give you the why as to what it is that I'm looking at. All right. Stanley asks, please give me your thoughts. Oh, by the way, Ben, if you are going to do that, day trade it. Look at an hourly time frame. I would not commit to a longer term time frame against what seems to be a rising tide and frankly a new high, right? Okay. Walmart. Walmart is completing a minor low pattern, and anything really over 147.31 is fairly bullish. With the minor low, we're above the 200. We're oversold. We were in an uptrend. We're trying to lose a little bit of that uptrend, but bullish bias. Minor low pattern has triggered, and I would look for more follow through to the upside, which would remain valid as long as we remain above 145. All right. Next up is, hey there, Jay, from our training room. Let's see. What is the name? Oh, where am I? I'm in the Sector Secrets Mastery. I'm in the Sector Secrets Mastery. You can check it out. There is some long URL, which sector, or you can just go to sectorsecrets.com. All right. So yeah, the Sector Secrets Mastery. All right. Thank you for the question. Rich asks, on TradingView, what is that lower indicator that's new? No, it's not new. It's the multi-trend, my friend. Yeah, that's all that it is, the multi-trend. You've probably seen it on my charts before. I've had them on there for a few years or longer. I don't remember at this point how long we've got them down there. Yeah, that's the multi-trend. And then what's above it? That's the slow stochastic. Yeah, that is the slow stochastic. It's not new. It's just a slow stochastic. You got it. It might look a little different, right, Rich? Nope. It's a slow stochastic. 21K, 3D, and then below it is the multi-trend. You got it. Thanks for the question. The stochastic, good eye, because that's exactly what it is. It's a slow stochastic, though, right? The way that I've found over 25 years that makes this work unbelievably well in a neutral environment to identify overbought and oversold is to slow that thing down to a 21K3D. And just like that, gang, that's a wrap. That's our show for today. My mastery folks, I'll see you in the room momentarily. Everyone else, have a wonderful weekend. I will see you all in the free video tonight. If you want to know how we're doing in the mastery in the futures room, I'll do another breakdown like I did last Friday. And I'll see you for This Week in the Markets, the newsletter that I do each week. We have a show, This Week in the Markets, live on the Simpler Trading YouTube channel and all the other places that you find my show. Okay, gang, 6 p.m. Sunday. Till then, be good to each other.